an introduction to options. If you've been investing in stocks for a while, no doubt you've heard about options, and maybe you're looking to add them to your investing arsenal. Why wouldn't you? They're a cheap way to add potentially huge profits to your portfolio. But before you jump into trading them, you should make sure you understand the basics. Essentially, options are just another way to invest in stocks. It's not quite as direct as just buying a stock, but the beauty is that they give you more flexibility and choice over the cost and timing. Simply put, a stock option is a contract that gives an investor the right, but not the obligation, to buy or sell shares of an underlying stock at a set price on or before a set date. You can buy and sell options contracts on regular stocks, indexes, ETFs, and futures contracts in the commodities world. And you can trade them over exchanges from the comfort of your online trading account. There are two types of options. The first is known as a call. This is a bullish investment that a stock's price will rise to a specific level within a specific amount of time. The second is called a put. It's a bearish investment that a stock's price will decline to a specific level within a specific amount of time. Forget that we're talking about stocks here for a moment. Let's use an example that should make the concept a little easier to understand. Say you've been looking for a new car, and after doing your research, you come across the perfect one at the perfect price. But there's a problem. You don't want to take out a loan to buy it, and you won't have the money to buy it outright for a couple of months. So you call up the dealer, and he offers you a deal where, for an upfront payment of $1,000, you have the option to buy the car in 4 months for a price of $20,000. That sounds fair to you, and you agree. At this point, one of two things happens. The first scenario is that after hiring a mechanic to double-check the car's condition, you learn it's an extremely rare model, with a market value around $200,000. The dealer obviously doesn't realize this, but even if he finds out, it doesn't matter. He sold you the option to buy the car for $20,000. So 4 months later, you spent a total of $21,000 for a car worth 5 times as much. You'd rather have the cash than the car, so you sell it. In the process, you've made $179,000 free and clear. The second possible scenario is that after hiring a mechanic to double-check the car's condition, you learn that there's a lot of work needed on the car to even make it drivable. Work that will cost more than you are willing to pay for a car in perfect condition. Needless to say, you don't want to buy the car any longer. So what happens? You walk away from the deal. Of course, you lose the $1,000 fee you paid for the option to buy the car, but that's a whole lot better than being out the $20,000 you would have paid had you bought the car outright. When options are applied to stocks, they work in exactly the same way. If the stock value shoots up, you have the right to buy it at the original price you negotiated. If the stock tanks, you simply let the option expire and lose only the money you put up for the option in the first place. That's how a call works. A put is a bit different, but it's just as easy to understand. You see, while a call is like buying a car, a put is like buying insurance on the car. So say you went ahead and bought that car from earlier for $20,000. The obvious next step is to buy insurance. So you go ahead and get a $1,000 per year policy for the vehicle. A month later, someone plows into the car while it's parked on the side of the road, and it's totaled. The car is now worth nothing, but luckily for you, the insurance is there to help you out. The insurance company values the car at $18,000 and cuts you a check for that amount. So what are you out? Only the insurance fee you paid to cover the vehicle. In all, instead of losing $20,000 outright, you've managed to lose only $3,000. Of course, that's not ideal, but it's a whole lot better than losing everything. When puts are applied to stocks, they work the same way. If you've bought a put on a stock, even if that stock's value tanks to zero, you've still got the right to sell it at the price you negotiated. So you may lose some of your investment, but you won't be stuck losing all of it. Now that you've got a good grasp on how calls and puts work, let's cover some of the basic terminology you'll want to know before you start trading. Ask. This is the lowest price one is willing to receive for an options contract. Bid. This is the highest price a buyer is willing to pay for the options contract. Trades are usually executed somewhere in this range, called the spread. Contract. Options come in contracts, with 100 shares equivalent to one contract. So one call option contract gives its holder the right to purchase 100 shares of the stock. Exercise. This is what it's called when you implement the right inherent in an option. Either you buy or sell the related stock. Expiration date. All options expire at a specific time, usually on the third Friday of the corresponding month. At this time, the contract must either be fulfilled or it expires worthless. Premium. This is the price that the holder of an option pays and the seller of an option receives for the rights conveyed by the option. Strike price. The strike price is the price at which an option holder has the right to either buy or sell the stock. Underlying security. The underlying security is the stock or other asset subject to being purchased or sold upon exercise of the option contract. The next thing you need to know is how options are identified and how long they last. When you're looking at the options you can trade on a particular stock, they'll be identified by the month they expire and the strike price at which you can buy or sell the stock. As you already know, these typically expire on the third Friday of the month. But when you're talking about really big companies, you might also find weekly contracts that expire each Friday. You also need to keep in mind that options contracts have limited lifetimes. You either buy or sell the option or underlying stock on or before the expiration date, or the contract expires worthless and you're out the premium you paid. One last thing to know before you get started trading is how to calculate the value of the options. There are two parts that add up to the whole value of each contract. They are the intrinsic value and the time value. Intrinsic value is simply how much the option is worth if you exercise it right now. You can find intrinsic value by comparing the strike price to the market price of the underlying security. If a stock is trading at $40 and you have a $35 call, you can buy the stock at $5 less than everybody else. That $5 is the intrinsic value of your option. The time value of your contract is just any value of that option other than the intrinsic value. So, if a stock is trading at $40 and the $35 call option trades at $6, then we'd say it has a time value of $1. That's the $6 option price minus the $5 intrinsic value. Now that you've got a basic understanding of options and know some of the terminology, you're ready to start trading. If you want to learn even more, check out our options advisory service, Options Trading Coach. There, you'll find lots of reports with even more information on more advanced trading strategies. Plus, there are more videos like this one to help you become an options expert.